want to welcome everybody to our call today with Ed Newton, CPA, CFP, and President of Newton Financial Network. Ed is going to discuss several tax increases scheduled to go in effect in 2013 that make your tax planning here at the end of 2012 very important. If you're not already a client of Ed's, he's originally from Huntington, West Virginia, has a degree in accounting from Virginia Tech, and a master's degree from Liberty University. Ed landed at Arthur Andersen after college and in their tax department, and then began his CPA firm in 1977. He is a CPA and a certified financial planner and is uniquely positioned to help clients achieve and sustain a worry-free retirement. And if you do know him, you know Ed has also been a commercial pilot for a major airline since 1982, and his current weekend routes are to London, England, and Frankfurt, Germany. Ed, welcome to the call.
Well, thanks, Jeff. I appreciate that, and I might just add that starting in November, I'm going to get to make a trip or two to Rio de Janeiro, so I'm looking forward to that as well.
Lucky you, lucky you.
Well, what I wanted to cover today, folks, was some dramatic tax increases that are scheduled to go in effect in 2013 that I believe make 2012 tax planning imperative. The following taxes are just three of the ones that are scheduled to be impacted. The Bush administration tax cuts, we've all heard about those, are set to expire, but there's also a new 3.8% surtax on investment income and a possible restated clawback of itemized deductions that could raise the effective tax rate to as high as 44.6% for some taxpayers. The second item is similarly, the tax rate on long-term capital gains could increase from 15% to 20%. That doesn't sound like a great increase, but it's still a pretty good one. But the rate on qualified dividends could go from 15% to that higher effective rate of 44.6%. Finally, if Congress doesn't take action, the federal estate tax rate will increase from 35% to 55% as a maximum, and the exclusion amount could drop from current $5.12 million all the way down to $1 million. So on our call today, I'm going to suggest some ways that we can avoid or minimize the adverse effects of these changes. Planning for these likely tax changes is a major undertaking, and many clients are beginning to process now rather than waiting to see what happens after the elections in just a few days. This is prudent, I believe, because the additional time that you allow to do these tax planning and available to get more comfortable with the gifting process will provide time to customize design trust for your families and that sort of thing. So first off, let's talk about what I call gain harvesting. For many taxpayers, it's going to make sense this year to harvest some capital gains in 2012 to take advantage of the lower current capital gains rates. You would sell appreciated capital assets and immediately reinvest that same amount of money into similar assets. You would also then hold the new assets until you would otherwise have sold them, so there'd be no change in your investment strategy whatsoever. Deciding whether to use the strategy is not as simple as it might appear on the surface, because the lower tax rates must generally be weighed against a loss of tax deferral. By harvesting the gains in 2012, you would be paying a lower tax rate, but you'd be recognizing the gains earlier. The greater the differential in tax rates and the shorter the time before the second sale, the more favorable that gain harvesting would be. In some cases, the correct decision would be clear without doing any analysis at all. For example, if you're currently in the 0% long-term capital gains bracket, 2012 gain harvesting would always be favorable for you because it would give you a free step up in basis. Gain harvesting would also be more favorable if you plan to sell the stock in 2013 and 2014 anyway. The time value of the tax deferral would be small compared to that of the future tax savings. At the other extreme, if you're in the 15% long-term capital gain bracket and you plan to die with an asset or pass it on to heirs with a stepped-up basis, there's really no reason to recognize that gain now. You'd be incurring tax now without any offsetting future benefit. nor would it make sense, in my opinion, to harvest these losses to create additional capital loss carryovers. The loss carryovers would be better employed to offset capital gains in the future when the rates are expected to be higher. Now, if you don't fall into one of these two categories, you'll have to do a little bit of quantitative analysis to determine whether the 2012 gain harvesting would work for you. The decision would be thought of as buying a future tax saving by recognizing gain in 2012. By analyzing the decision this way, you could measure return on the 2012 investment over time. If this return on investment exceeded your opportunity cost of capital, gain harvesting would then make sense for you. We do have some software that we can utilize that enables us to do this analysis quickly, easily, and economically for you. So if that's something that you'd like to do, please contact us to find out which of the assets should be harvested for 2012. Next is planning for the 3.8% Medicare surtax. For the years beginning January 1st, 2013, the law imposes a 3.8% surtax on certain passive investment income of individuals, trusts, and estates. For individuals, the amount subject to the tax is the lesser of either your net investment income or the excess of your modified adjusted gross income over an applicable threshold amount. Net investment income includes things like dividends, rents, interest, any passive activity income, capital gains, annuities, and royalties. Specifically excluded from that definition, though, is of net investment income is self-employment income, income from an active trader business, gain on the sale of an active interest in a partnership or an S corporation, an IRA, qualified plan distributions, or any income that you might get from a charitable remainder trust. This modified adjusted gross income is generally the amount that you report on the very last line of the page 1 of the 1040. Now, for the year 2013, these applicable threshold amounts are $250,000 for married taxpayers filing a joint return. They cut it in half for married taxpayers filing separately, so it's only $125,000 threshold. And then for all other individuals, it's $200,000. A simple example will illustrate how this tax is calculated. Let's take Al and Barbara, married taxpayers filing separately. They've got $300,000 of salary income and $100,000 of net investment income. The amount subject to the surtax is the lesser of the net investment income, $100,000, or the excess of their modified adjusted gross income, $400,000, over the threshold amount, $250,000, equals $150,000 modified adjusted gross income. Because the net investment income is smaller, it's the base on which the tax is calculated. So you take the $100,000, multiply it by the 3.8%, and they've got an excess or an additional tax of $3,800. Fortunately, there are a number of effective strategies that we can use to reduce the modified adjusted gross income or the net investment income and reduce the base on which that surtax is paid. These include things like the Roth IRA conversions, tax-exempt bonds, tax-deferred annuities, life insurance, rental real estate, oil and gas investments, timing of the estate and trust distributions, as well as charitable remainder trust, and finally installment sales and maximizing the above-the-line deductions, as we call them. Again, we'd be happy to explain any of these to you. Take a look at your own situation and see if we might be able to save you some of this surtax that's coming up. Next is the accelerating ordinary income into 2012. A final opportunity that should be noted is accelerating ordinary income into 2012. Perhaps the best way to do this would be to convert a traditional IRA to a Roth IRA in 2012, if a conversion otherwise makes sense. Ordinary income could also be accelerated by selling bonds with accrued interest in 2012 or selling and repurchasing bonds trading at a premium. You also might consider exercising some of your non-qualified stock options in 2012. Last is the estate tax provisions. The estate tax exemption is currently $5,120,000 per person and is set to revert to $1 million on January 1st, 2013, unless Congress acts. The President is suggesting a $3.5 million exemption. The potential reduction in this estate tax exemption is resulting in many clients of ours making large gifts in trust for their family. In some instances, the trusts are for the spouse, children, grandchildren, and in others, just for children in the younger generations. Most experts would define the savings at 35%, 45%, or 55% of the amount gifted over $1 million. So if we take the middle of the road there on a $5 million gift, the savings would be $1.8 million. Well, that's it. These are the changes that are on the horizon for 2013. If you have a question or concern about any one of these tax topics, or if you'd like to see what's involved in doing some tax planning here in 2012, please give me a call here at the office, 704-552-8689, or send me an email at ednewton@ednewtoncpa.com.